I want you to imagine, just for a second, that you're driving down the highway. The weather is perfect. The radio is playing your absolute favorite song, and you look down at your dashboard.
Right.
Every single indicator light is glowing this reassuring bright green. The temperature is optimal. The fuel is full. Oil pressure is flawless. But underneath the hood, inches from the engine block, a crucial serpentine belt is fraying.
Oh, wow.
Yeah, it's hanging on by a single thread, and it's completely invisible from the driver's seat.
I mean, that's a terrifying scenario because, your confidence is being actively reinforced by the very system that's failing you.
Exactly.
The dashboard isn't just like ignoring the problem, it's actively manufacturing a false sense of security.
Well, welcome to this custom deep dive. Because that terrifying disconnect between the shiny dashboard and the failing engine belt, that is a perfect mirror for what is happening in the global financial markets right now.
It really is.
Today's mission is to explore a fascinating financial dispatch titled The Unpriced Discontinuity. We're going to unpack the massive gap between the rosy, comfortable numbers flashing on financial screens worldwide and, well, the deteriorating plumbing beneath the global economy.
Yeah, and for anyone wanting to understand how hidden risks actually drive the world, I mean, consider this your ultimate shortcut.
So tell us about the sources we have today.
Yeah, so the sources we're working from today are just exceptionally revealing. We're looking at a really detailed briefing from a sovereign debt desk.
Okay.
And they're analyzing a specific week where global markets basically misread 3 massive systemic warnings as green lights.
Wow, 3 of them.
Yeah, 3. And this isn't, some theoretical modeling. This is a real-time log of market blindness.
Reading through this dispatch, the analogy that kept hitting me wasn't even about cars, but architecture.
Oh, yeah.
It's like looking at a massive suspension bridge. The traffic is flowing smoothly, the paint is fresh, everyone feels completely safe, but the main load-bearing cable is starting to snap, just one wire at a time.
Right.
The market is basically staring at the smooth traffic and congratulating itself on a well-built bridge.
Yeah, and the dispatch notes that the market essentially spent the week paying itself for misreading those snapping wires.
Oh, so?
Well, we see this quantified in indices that track emerging market bonds, specifically the EMBI Global Diversified Index. It recently held near 229 basis points.
Okay, let's translate that for a second for you listening.
Yeah.
When an index like that is trading that tight, it means investors are demanding almost no extra premium to take on massive risks in emerging markets.
Exactly.
They're looking at the landscape and deciding it's just completely safe.
Right. They believe all the structural risks of the quarter have been just neatly filed away and resolved.
Yeah.
And you see the compounding effect of this retail euphoria everywhere.
Like with the IPOs, right?
Yeah. There was a $3.6 billion Chinese renewables IPO this exact same week that absolutely skyrocketed. It tripled purely on retail demand.
Which is wild.
It is. The market looks at a tripling IPO and interprets it as proof that risk appetite is incredibly healthy.
But the tape is completely ignoring Tokyo. Like, entirely.
Oh, completely.
Because the Bank of Japan, the BOJ, they hiked rates to 1%. But at the exact same time, Tokyo engaged in this massive fiscal expansion.
Yeah, it makes no sense on paper.
Right. They rolled out tax cuts and flooded the system with new spending and bonds.
Yeah.
And because of that glaring contradiction, the rate hike was totally overrun.
Yeah.
The yen just quietly broke through a 40-year floor against the dollar.
And the mechanics of that contradiction are, they're vital to understand because raising interest rates is supposed to cool an economy down, right?
Right, and strengthen the currency.
Exactly. But if a government is simultaneously injecting massive amounts of stimulus spending, they're essentially pouring gasoline on the fire they just tried to put out.
They just tried to put out.
The result is that 40-year floor breaking. Yet the psychological framing from the market consensus was to read the yen sliding to a historic low simply as, harmless stimulus.
I have to push back on the market's logic there.
Please do.
The market sees a 40-year low in a major globally foundational currency and just slaps the label harmless stimulus on it. I mean, a weakening currency isn't a deliberate stimulus if the central bank authorities are currently in a panic.
Right. They're playing a guessing game behind closed doors about whether they need to intervene to stop a total collapse.
It's like seeing water pooling in your basement and calling it an indoor pool completely ignoring that the pipes are bursting.
That's exactly it. And the dispatch explicitly flags this delusion. They call it the 60-day assumption.
60-day assumption.
Yeah, it's this dangerous habit institutional investors develop where if a risk has been on their radar for a couple of months without detonating, they just assume it's structurally resolved.
Even if the fuse is still burning.
Right. They assume the BOJ's move to 1% is fully absorbed by the system, completely ignoring the fact that the underlying mechanics are screaming otherwise. I mean, a tripling IPO is historically a late-cycle warning sign of an overheated market.
Not an all-clear signal.
Exactly.
So if I'm a bondholder sitting in London, I must be terrified by this.
You should be.
I mean, I'm essentially making a bet on a developing nation like Pakistan or Egypt, but my survival is entirely dependent on Tokyo not panicking. How are debt desks even positioning for that kind of layered risk?
Well, it's tricky.
We really need to unpack how a currency fluctuation in Tokyo threatens an economy in Africa or South Asia.
Yeah, let's do that. It comes down to what the dispatch calls the yen carry funding leg.
Okay, the yen carry. Let's break that down.
Let's walk through a hypothetical transaction to see how this hidden engine build actually functions. So, for a long time, the Japanese yen has been incredibly cheap to borrow because of their rock-bottom interest rates.
Right, near zero.
Exactly. Let's say an institutional investor borrows 1 billion yen at an interest rate of basically 0%.
But they aren't just sitting on that yen, they convert it, right?
Right. They immediately convert it into US dollars. Then they take those dollars and search for yield.
Which brings them to the frontier markets.
Yep. They buy a sovereign bond issued by a frontier market. You know, a dollar-scarce country like Ethiopia, Egypt, or Pakistan, that might be paying out a 10% yield.
Wow. Okay, so the investor pockets the massive difference between the 0% they pay Tokyo and the 10% they get from Addis Ababa.
Exactly. They are effectively refinancing these frontier nations against the Japanese currency.
So the International Monetary Fund, the IMF, they were surveilling Japan and assuming this massive interconnected carry trade was just going to normalize smoothly.
That was the assumption, yeah.
They assumed Japan would pair its rate hikes with fiscal tightening, so the currency would adjust gracefully without causing, like, a global shockwave.
But reality delivered the exact opposite. We got the 1% rate combined with record fiscal expansion, creating wild variance.
Right.
And here is where we have to distinguish between two crucial concepts the dispatch highlights. The drift versus the jump.
Ah, okay. The jump versus the drift.
Yeah, so if the yen just slowly, gradually drifts lower, the funding costs for these investors drift with it.
The yield curve changes incrementally.
Right, and bondholders can easily adjust their portfolios and just pretend nothing fundamental has changed.
But the jump is the earthquake.
Yes.
If Japan's Ministry of Finance finally decides enough is enough and they step in to aggressively defend the yen like buying it up in massive quantities, the currency doesn't drift. It snaps higher instantly.
And when it snaps higher, that carry trade unwinds in a single trading session.
Oh, man.
Let's go back to our hypothetical investor. Suddenly, the 1 billion yen they borrowed at near 0% becomes vastly more expensive to repay because the yen's value against the dollar just spiked.
So that 10% yield they were earning in Ethiopia is instantly wiped out.
Instantly. Wiped out by a 15% currency spike that happened in an hour. Margin calls hit. And in that moment, the marginal buyer of frontier duration completely vanishes.
Let's clarify marginal buyer for a second.
Yeah.
We're talking about the incremental investor-like, the one who is willing to buy the next bond issued by these countries to keep their economies afloat.
Right.
If that buyer evaporates, the country can't raise money. So the frontier market isn't just borrowing foreign capital.
No, they're not.
They are actively borrowing a foreign currency's stability. And right now, that stability is sitting at a 40-year low, exactly one major intervention away from breaking.
So a bondholder funding a position in Islamabad or Cairo is basically long a calm in Tokyo that they have absolutely zero control over.
Zero.
The investor is exposed to a catastrophic shock they simply cannot see on the local ledger of the country they are invested in.
Right. The screen says the Ethiopian bond is performing fine.
But the plumbing in Tokyo is about to burst.
Wow. So if the macro-level global currency is lying to us on the dashboard, what happens when we look at the actual ledgers of these frontier countries? Are they lying too?
Oh, absolutely.
Because the dispatch outlines a massive vulnerability sitting completely off the balance sheets of nations like Nigeria and Indonesia.
Yeah, we can start with Nigeria. The IMF is currently initiating a major crackdown there on the use of total return swaps. or TRS.
TRS, what exactly are those?
These are highly complex synthetic derivatives. In practice, they allow a sovereign nation to take on massive debt obligations, but legally classify them in a way that hides them outside of their officially reported debt stock.
Oh, wow. It sounds identical to having a massive secret credit card.
Yeah, that's exactly what it is.
Like you max it out to fund your lifestyle, but because it's a shadow account, you manage to completely hide it from the bank when you go in to apply for a mortgage.
That's a great analogy.
Your official credit report looks pristine, but the reality is you are drowning in hidden obligations.
The mechanics match that analogy perfectly. Because a total return swap means a bank technically holds the underlying asset or the immediate risk, the sovereign nation doesn't have to report it on their primary ledger.
Wow. So it just evades the debt sustainability analysis completely.
Completely. The DSA that bondholders and global rating agencies rely on to assess a country's health, it misses it. It's an IOU written in invisible ink.
But the IMF is now forcing these positions into the daylight.
They are.
Which begs the question, isn't the IMF forcing transparency a good thing for Nigeria? I mean, we want accurate ledgers so the market functions rationally, right?
It raises a critical issue of timelines.
Okay.
Over a 5 or 10-year horizon, transparency is absolutely necessary for a functioning market.
Right. Long term, it's good.
But in the near term, forcing hidden leverage into the open triggers a severe, immediate repricing shock. When those secret credit cards are forced onto the mortgage application, the reported debt-to-GDP ratio is suddenly revealed to be vastly worse than anyone modeled.
Ah, so the true maturity wall-like, the date when a massive wave of debt suddenly comes, due shifts, uncomfortably close.
Exactly. And the dispatch notes that under moments of stress, these swaps behave exactly like short-term external debt.
So they can unwind rapidly.
Yes.
Yeah.
Forcing the sovereign to scramble for dollars, which violently widens the spreads on their underlying bonds. And it happens entirely regardless of the country's actual on-the-ground economic fundamentals on that given Tuesday.
The market panics simply because the invisible debt just materialized on the screen.
You got it. And Indonesia offers another angle on the same lesson.
Okay, what's happening there?
The dispatch highlights a transition unfolding right now in Jakarta. It's a shift from a theoretical narrative warning to hard, undeniable data.
I remember a while back, the sovereign debt desk flagged that Indonesia's trade surplus had hit a 6-year low. It was a big warning sign.
It was. But this week, the number actually flipped.
Oh, no.
Yeah, it is now an outright trade deficit, their first in 6 years.
Let's unpack the jargon the dispatch uses here. It says, import cover compresses while the primary balance widens. What is actually happening inside Indonesia's treasury when they say that?
It means Indonesia is suddenly burning through the hard cash reserves they desperately need to pay for essential daily imports.
So that's their import cover.
Right. And while those reserves are shrinking, their core government budget deficit is actively widening. It's a concealed deficit that suddenly materialized.
And the timing is incredibly fragile, isn't it?
Extremely. Because this economic data flip is colliding with a severe foreign investor shock. A Jakarta court just sentenced the former chief of Gojek, one of the largest tech unicorns in the region, to 10 years in prison.
The street is watching that case. So suddenly you have a rapidly visible trade deficit amplifying a sudden crisis of investor confidence in the local rule of law.
Exactly. It's a perfect storm for capital flight.
So if capital is fleeing these frontier areas with massive hidden risks, like Nigeria's secret ledger swaps, or Indonesia's evaporating trade surplus, where is the global liquidity flowing instead? Who is actually manufacturing confidence in plain sight?
The dispatch points directly to India.
Really? India?
Yeah. India is currently presenting as the exact inverse of Japan. While foreign investors in Tokyo are quietly fearing a backslide into economic nationalism, India is actively manufacturing massive catalysts and doing it with complete transparency.
The scale of the pipeline is staggering, from what I read.
It is.
The dispatch lists a $7 billion listing pipeline just waiting to launch. Amazon just cemented itself as the largest foreign investor in India's AI sector.
Yep.
New Delhi just signed a first-of-its-kind defense co-development pact with Japan. Plus, Tokyo is stepping in to provide trade insurance for Reliance's massive solar and battery build-out in India.
It's just a relentless drumbeat of visible positive catalysts.
So what gives the desk confidence that this isn't just another mirage?
Well, what gives them confidence in India is that the invalidation risk is highly specific and equally visible. The primary threat to India's momentum isn't a hidden swap or a surprise central bank intervention.
What is it?
It's the weather. specifically a failed monsoon season.
Wait, really? Why does a bad rain season threaten a massive tech and defense boom?
It comes down to the mechanics of food inflation. If the monsoons fail, agricultural output plummets.
Okay, that makes sense.
When food supply drops, food prices skyrocket across the country. That inflation forces the central bank into a brutal rate hold dilemma.
Ah, I see. Because if the economy starts to slow down because of the agricultural hit, the central bank would normally cut interest rates to stimulate growth.
Exactly. But if food inflation is raging, they can't cut rates because cheaper borrowing would just pour more gasoline on the inflation fire.
So their momentum stalls out completely.
Right. But assuming a normal monsoon, India looks like a fortress.
But there is a fascinating darker side to this, isn't there?
There is, yeah.
Because India's immense economic gravity actually operates as a hidden risk for its smaller neighbors. The dispatch uses this incredibly vivid, real-world example: a crate of Nepali tea stalled at the Indian border.
It illustrates the raw mechanics of geopolitical leverage. The tea is stalled not because of a formal publicized tariff, but because India suddenly instituted quality checks.
Quality checks.
Right. That distinction changes everything about how risk is priced. A tariff is a known financial cost. A macro hedge fund can model it, price it into the bond yield, and move on.
But a quality check.
A quality check is an administrative barrier. It's a valve on a pipe, and New Delhi solely controls the handle.
We always think of sweeping economic sanctions as the dramatic weapons of global trade.
Yeah.
But a sudden quality check on a crate of tea is essentially silently closing the only highway out of town.
Precisely.
Because Nepal is a landlocked frontier country. They rely almost entirely on India as their dominant market, their physical transit route to the sea, and the vital corridor for the remittances that actually stock Nepal's foreign reserves.
Yeah, and by choking off one of Kathmandu's few export earners via a sudden regulatory hurdle, that compression feeds straight through to Nepal's foreign exchange receipts.
And those are the hard currency receipts Nepal desperately needs to service its own external debt.
Exactly. And India is flexing this administrative muscle on multiple fronts. The dispatch notes that India expelled thousands of migrants into Bangladesh in the dead of night this same week.
So the takeaway for you, the listener, or for a frontier bondholder, is that small South Asian sovereigns are not in control of their own economic destiny.
Not at all.
They are completely price takers on India's administrative decisions. And that is an idiosyncratic risk that a generic bond spread simply doesn't catch.
No, it flies right under the radar.
You look at the screen, and Nepal, or Bangladesh's generic spread, is holding steady, completely missing the fact that New Delhi just tightened a valve that will starve them of hard currency in a matter of weeks.
The dashboard is showing green, while the geopolitical belts are fraying under the hood.
So we've covered the yen's structural contradictions, the hidden ledgers in Africa, and the stark contrast between India's visibility and its neighbors' vulnerability.
Yeah.
How does a sophisticated sovereign debt desk actually position billions of dollars when they know the dashboard is lying to them?
Well, they operate on the principle of unseen risk. The dispatch lists them as cautious on Indonesia across the entire capital structure.
And they're holding that stance.
Yeah, they are refusing to change that stance until they see a restored trade surplus and, crucially, until the upcoming MSCI review is settled without any delistings.
Let's define the MSCI review for a moment, because that's a massive hidden trigger.
It really is.
MSCI is a major global index provider. Trillions of dollars in passive investment funds automatically track their indices. If MSCI reviews Indonesia's equity market and decides to delist certain companies or downgrade the country's weighting, all those passive funds are forced to automatically sell.
Yep. It triggers a massive, uncontrollable capital outflow. It's an automated dump of the country's assets.
So the desk stays cautious.
Very cautious. They're also cautious on Nigeria's hard currency debt. They are waiting on the sidelines to see if the IMF's push for disclosure lands without triggering massive upward revisions to the official debt stock.
Or forced, panicked unwinds of those total return swaps we talked about.
Exactly.
Right.
And, as we discussed, they are selectively constructive on India, provided the monsoon rains arrive.
Right. So if India is the safe harbor, what does a purely binary risk look like in this environment?
Well, the dispatch points to Pakistan for that, labeling their external sovereign debt as having pure asymmetry. Meaning the entire investment thesis rests completely on the geopolitical track between the U.S. and Iran.
Wow. Talk about binary risk.
It's the definition of binary risk. Right now, that diplomatic track is stalled. The dispatch notes the negotiating parties weren't even in the same room recently in Doha.
So what are the mechanics of that binary?
They're stark. If a settlement is signed, it unlocks massive balance of payment support for Pakistan, like a huge stabilizing inflow of capital.
But if they stall,
If the negotiations remain stalled, Pakistan's massive maturity wall remains entirely untouched. They still owe the money, but the geopolitical lifeline they were counting on just vanishes.
the dispatch summarizes all of this beautifully with the phrase, the arithmetic of the unseen.
I love that phrase.
Me too. The financial market is ultimately a machine for pricing what it can clearly see. It sees a manageable rate hike in Tokyo. It sees a tripling renewables IPO. It sees a stimulative currency. And it prices that as safety.
Right.
But the risks that actually detonate economies rarely carry a live quote on a Bloomberg terminal.
Exactly. The risk is the central bank intervention that hasn't fired yet. It's the total return swap hiding off the balance sheet.
Or the trade deficit that the previous surplus was camouflaging.
Exactly. The visible risks are already priced into the market by every algorithmic trading desk in the world. And because they are universally priced, that risk is cheap.
The defining piece of advice in the dispatch is price the jump, not the drift.
Yeah.
Let's really hammer home what that means for how we perceive stability. So if I'm understanding this correctly, it's about preparing for the earthquake rather than spending all your time measuring the gradual millimeter shifting of the tectonic plates.
That is the perfect way to put it. Measuring the drift-like, the gradual daily changes in bond yields or currency valuation, it gives an investor a dangerous illusion of control.
Like you can just step off the ride whenever you want.
Exactly. It makes you feel like you can smoothly exit your position before things get too turbulent. But the jump, the sudden central bank intervention, the unexpected release of hidden debt data, the sudden collapse of a diplomatic channel, that happens in a single trading session.
Oh.
If your portfolio hasn't priced in the statistical possibility of the jump, the arithmetic of the unseen will wipe you out before you can even click sell.
And that brings us to the ultimate synthesis of this deep dive, because the real lesson from these sources isn't just about frontier debt or the intricate mechanics of the yen carry trade or even the geopolitical weight of Nepali tea exports.
No, it's bigger than that.
It's that the number that ends up costing you the most is the one that was never on the screen to begin with.
Always.
The dispatch offers this moment of striking humility, actually. They note that just 2 weeks prior, they called the yen carry floor permanent.
Yeah, they explicitly admit that the vocabulary of permanence ages terribly in finance.
It really does.
Whenever analysts catch themselves using words like permanent, settled, or absorbed to describe a complex, deeply dynamic global system, they're almost certainly staring at the fresh paint on the bridge and completely ignoring the snapping cables.
And the market delivered its rebuttal to the word permanent by quietly dropping the yen to a 40-year low.
Sure did.
Which leaves us with a final lingering question for you to ponder on your own. We've spent this entire deep dive looking at global finance, central bank interventions, and sovereign debt. But it leaves you wondering, if the smartest, most resourced debt desks in the world are warning us that the dashboard is fundamentally broken, how much of our own global economy is currently running purely on the momentum of a dashboard that hasn't updated to reality yet?
It's a scary thought.
And bringing it closer to home, what are the total return swaps you might be hiding off your own personal balance sheet? Are you measuring your own stability using visible, lagging indicators while ignoring the jump risk building up underneath?
That's the real question.
The next time someone tells you a trend is permanent, remember the arithmetic of the unseen. Thank you so much for joining us in this custom deep dive. Keep asking questions and keep looking past the screen.